Good morning, everybody. Anybody out there? I know it's Friday. I know it's sunny. We'd much rather be outside. Look, I've spent 40-odd years working in financial services. And the question that's on my mind is this the end of the beginning for fintech or the beginning of the end? And what do I mean by that? The question is really, have we, after 15 years of the fintech journey, reached a new point of equilibrium where the incumbents and the fintechs coexist? Or have we merely reached a plateau from which we can power forward and build a financial system that is fairer, cheaper, and more inclusive? And I will argue today that we, the key actors in this, fintechs, incumbents, governments, should be pushing to make sure that this is the end of the beginning. Because I believe that if we harness the power of fintech, we can create that financial system that is fairer, is more inclusive, and is cheaper for all to participate in. So I want to address that question in the context of three areas, three domains: the past, the present, and the future. So let's talk about the past. We are here in the City of London. The City of London has been the epicenter of financial services for millennia. But in many ways, what we've done is we've automated the physical world. If I think back over my career, I was actually a child in 1967, but in 1967, the world's first ATM was launched just north of here in Enfield at a branch of Barclays. And the idea that you could get cash out of a hole in the wall was radical. In fact, the apocryphal story is on the day of the launch, the machine didn't work. So there was a member of the staff at the back pushing the cash through the slot. And in many ways, that's not a bad metaphor for a lot of what goes on in fintech today. Fast forward, we had the launch of call center banking. Then in the late 90s, early 2000s, we had internet banking. And then in the late 2000s and somethings, early 2010s, we had mobile banking. So we've seen this wave of new innovation and technology being deployed in financial services. And we could talk about other areas like derivatives trading, the whole fixed income and commodities and currencies business, all of which have been aided and automated by technology. But then we come to 2008, the global financial crisis. The veil was lifted. Sounds like the emperor has no clothes, right? The financial system is corrupt, it's broken, it's run for the interests, maybe of shareholders, but actually really of employees. The system craters, not everywhere in the world, but in many of the developed parts of the world, the system has to be bailed out by governments. But it's not actually bailed out by governments, it's bailed out by citizens. And this creates the impression that the game is rigged, that shareholders make money, employees make money, but citizens get shafted when push comes to shove. In parallel with that, there is this constant emergence of new and fast-moving technologies. I am old enough to remember the first dot-com boom in the late 90s. I was working in New York at the time. In those days, people were raising millions of dollars of venture capital money just to buy servers. Fast forward to 2015, I'm in San Francisco. I'm in a loft talking to a very small AI startup. This was before AI was fashionable. And I said to them, you must need a massive amount of computing power to be able to deliver what you're delivering. And they said, yeah, it's fine. We just go buy it from AWS. So the barriers to entry for radical innovation were lowered. So you get this combination of rolling innovation through the decades, the great financial crisis that undermined confidence in the system, and then these new technologies that are available. And one of the pieces of advice I always give people is, if you really want to understand how innovation and transformation can happen and where the opportunities and threats are, you have to look at the underlying technologies. When COVID hit, we all started working from home. Everybody said, Thank God for Zoom, thank God for Teams. They have very little to do with our ability to work from home. Our ability to work from home is driven by the fact that we all have broadband in our houses. Broadband is the pipe that allows those services to be delivered. Without the deployment of broadband, it doesn't matter what front end you have, Zoom or Teams. So that brings us to the present. 15 years on from the launch of fintechs, where are we? Well, of course, fintech is not a homogeneous category. We have everything from B2C businesses like neobanks, payment companies, foreign exchange companies, wealth management companies, through to B2B2C companies like the one I chair, Redpin, formerly Currencies Direct, to B2B businesses like the one that I founded, 10x Banking. And all of these businesses have started. Some of them have succeeded, some of them have failed, some of them have demonstrated that you can build significant installed bases of customers where you can offer a much better user experience, a much better customer experience, and a much better economic proposition. And we see, neobanks here, for example, building significant customer bases. But we've also seen the incumbents respond. The incumbents haven't sat still. They've had to up their game, and very expensively, they've been able to deliver this user experience, which is not as good as the Neos, but it's not bad. It's functional. If you're using the Barclays app or the NatWest app, it works. And we've seen as a result of that a real change in how customers behave. So when interest rates spiked, the incumbents lost money at a huge rate of knots because they were offering poor interest rates, and with faster payments, you could move your money much easier to a provider with a better rate. So we've seen some benefits for customers. We've seen the ability to get a better user experience, to have more choice in the market, and to be able to benefit to some extent from these changes. But I would argue that that is merely the beginning of the end. That is the new equilibrium. Now, for the incumbents, of course, it's been extremely painful to do this because you're basically trying to yoke modern technology to technology that's sometimes 20, 30, 40 years old. I often describe banks as museums of technology because inside the bank, there's every type of hardware or software that's ever been invented. When I was at Barclays in about 2010, we had a problem with the statementing system. It suddenly stopped issuing statements. The code was written in 1977. It had performed perfectly well from 1977 to 2010, then it just stopped working. Written in COBOL, we were actually able to find the COBOL programmer who had written the code originally, and they fixed it. But yoking that type of technology to modern technology is very difficult. In the meantime, of course, we know that the capability of technology continues to march on. We are all familiar with Moore's Law. People have been saying we're going to reach the edge of Moore's Law ever since there's been Moore's Law, frankly. And yet we still keep going, seeing improvements in capability at much lower price points. I was told the other day that the functional capability of neural nets is doubling every 14 weeks as investment gets piled into AI. So that's the present. What could the future look like? Well, there's two futures I can see. One is a sort of steady state, more of the same, coexistence between the fintechs and the incumbents, maybe a bit of collaboration here and there. Or I can paint the vision of something that's radically different. And in order to think about what radically different looks like, we should look at the developing world. Because the developing world, frankly, has done a much better job of leveraging technology. It's easier to do when you don't have an installed existing way of doing things. So for those of you who are familiar with Africa, M-Pesa was a payment service launched in Kenya in 2007, not by a bank, but by a telecom. Basically Vodafone Safaricom in Kenya. And it allowed, using a very basic feature phone, the ability to move money between participants inside Kenya. It was basically leveraging a service that allowed people to buy airtime, and because Safaricom had an 85% market share in Kenya, They had a natural network. So they have been able to turn that into a real-time payment system, and that has added, it's estimated, over the period from 2007 to now, about 2% to Kenya's GDP every year. Look at India, where the faster payments, the UPI, was implemented. It's been estimated that the ability to make instant payments in India has added $65 billion of value to the economy in India. So when we look to different parts of the world, we can see a transformational future. But what needs to happen to deliver that in the developed world? And I would argue that there are three critical things that need to happen. One, governments. Governments need to grasp the idea of digital identity. You cannot take friction out of the system without identifying individuals digitally. This, if you think about it, this would massively smooth the onboarding experience. It would massively smooth KYC, fraud, AML. And once you can tokenize identity, you can then connect it and tokenize real assets, and then you can effect the transfer of the two. In this country currently, it takes between 5 and 6 months to sell a property, to transfer the ownership of a property. That is ridiculous. We should tokenize the property, tokenize the individual, and then you can put the two together and have instant exchange of value. But governments need to create the framework for this. Now, people get worried about privacy and all of that, and I understand it. But actually, if you think about it, the only authority that can confer physical identity on you, citizenship on you, is governments. We all carry a passport, we all carry a driver's license. Why not digitize that so we can use that as a token in the digital world? The second thing I would say, for the incumbents, you have to massively automate your technology. If you want to take advantage of artificial intelligence and all the operational benefits that will give you, the ability to make better fraud decisions, better credit decisions, you have to be able to get at the data in your systems. Right now, that is fragmented amongst many thousands of different databases inside the banks. They have to massively automate themselves, and they have to do that at pace. And finally, I would say for the fintechs, you have to keep pushing. It's not an easy time in the fintech world. We're at a point in the cycle where capital is hard to get. But the fintechs cannot give up. They've got to keep raising the bar and keep offering that improved customer experience, that lower access to credit, that better way of handling things like fraud and artificial intelligence. So for me, we are at this juxtaposition, this point in the road. It can be the beginning of the end, this new equilibrium, or we could create a radically different, more exciting, fairer, cheaper, more inclusive financial system. And my call to action to all of us innovators is, let's do that, because that's a lot better for society and a lot more fun than doing the other thing. Thank you.